The only solution to this is to go back onto a gold standard. And the way to look at it is that, a mechanism has to be put in place whereby credit, the value of credit, is securely tied to gold. And if it's not securely tied, then it's not good enough. It's desperately important that what we have today, which is failing, is replaced with something which is absolutely cast iron. Yeah, I mean, it's going back to central banks. I mean, what central banks are doing is not so much buying gold as dumping fiat currencies. That is the adjustment they're doing in their reserves. And I think that is the point which one's got to understand. You've got to look at it from their point of view. Their point of view is actually quite simple. We're holding dollars. Dollars are going down. We don't want dollars. What do you buy? Euros? No. We've got some of those. Sterling? No. Yen? No. We don't want to buy any of those. We've got them. Basically, we see risk in the dollar-based fiat currency system. So we've got to hedge that risk by selling them and moving into real legal money, which is metallic with no counterparty risk, and that's gold. So that's really what they've been doing. And I think it's a process that will continue. And I think the thing to understand about gold is its purchasing power obviously fluctuates, but it doesn't fluctuate by very much. Certainly not as much as the purchasing power of a fiat currency. And if you look at prices, say 2,000 years ago, for many of the common goods that we need, and as humans, you'll find that the prices in gold are actually quite similar to the prices today. So, this is, if you like, I'm not saying that gold is a sort of wonderful, beautiful, and it's absolutely steady and there's no variation in its purchasing power whatsoever. But what I'm saying is that taking everything into consideration, it maintains its purchasing power over a long period of time. And if you look at estimates of above ground gold stock and how that has been increasing, it increases at roughly the same rate as the world population. So in other words, the human users of gold, not that they use gold, so, we can come on to that in a second. The human users of gold basically find that, gold is expanding at roughly the same rate as the population, and therefore there is a constancy in that. They don't actually use gold, they use credit. And this is a point which nobody seems to understand. What do we do with gold? I mean, we have gold coins, maybe. We might even have bullion. But if you look at in terms of coinage, then gold coins and silver coins are not the thing you use first to pay for goods and services. No, it's the last thing. Gresham's law basically says that the bad money drives out the good. What's happening is that you spend the credit, if you like, which even on a gold standard is based on gold. It's linked to gold. And if you're worried about the value of that credit, then you encash it for gold coin. That's the way a gold standard works. And I think, I really find it, complete. It's just completely understandable that what's happening without any anchor, credit has no anchor to gold at all at the moment, that there is just huge risk in the whole system. And that is now coming true in the form of debt traps, in the form of government response to the necessary response, if you like, to any economic crisis, increased unemployment, whatever. They're just going to debase it further. It's too soon to say they're in trouble. Of that, I'm certain. And I think the problem is that in the policy of suppressing gold and trying to drive it out of the system and trying to get everybody to accept that gold is no longer part of the monetary system, but the dollar is king and the dollar has replaced it. That attempt has involved the use of gold being leased, if you like, and then sold into the market, and the proceeds then invested in a carry trade to buy US T-bills. I mean, this was the situation basically in the 80s and 90s. And Frank Veneroso, who was a highly respected analyst at that time, looked into this, and he came to a conclusion that anything between 10,000 tons and 16,000 tons of central bank gold had been used for this purpose and sold into the market. And presumably, as I think he put it, was adorning the necks, wrists of Asian women. In other words, it had gone. Now, the point is that, when you talk about 10 to 16,000 tons of gold, I mean, roughly it's a third to a half of all declared gold reserves at that time, at the year 2000, round about then. After that, I think that the central banks got slightly wiser about it. And you then had what was called a book entry transfer system, so that the Bank of England would say, okay, we're leasing, we have the agreement from, say, the Bank of Finland to lease half their 30 tons of gold stored with us. And we agreed the rate and all the rest of it, but it's not leaving our vaults because it's got to be stored somewhere. So, what happened was that the trade moved from a carry trade into US T-bills into a carry trade to provide liquidity for the forward market in London and also other derivative markets, including COMEX. And that probably means that instead of gold disappearing, you've now got double ownership of an awful lot of it in central bank vaults, in the Bank of England and also in the Bank of New York. Sorry, not the Bank of New York, the Federal Bank of New York. And I mean, I think proof of this problem was when, 10 years ago, 10, 11 years ago, I think it was 2013, actually, the Bundesbank decided, first of all, he wanted to go and inspect its gold at the Federal Bank of New York, and were told, under no circumstances we will permit anyone look at it. They then tried to get their gold back. And obviously negotiations took place, which we weren't a party to. And they ended up agreeing, very reluctantly, I would think, to having 300 tons of their, I don't know how much, 1,000 tons or whatever it was, returned over a 7-year period, would you believe? Why is it so difficult to do this? And this was so embarrassing, actually, for the New York Fed, that eventually they actually, sent the whole lot back several months after this 7-year agreement was announced. And then we had the Dutch saying, "Oh, hold on, we got 1,000 tons over there. We better get ours back." And they got it back. Okay. I understand that the bar numbers on the Bundesbank's return gold didn't actually match their records. So this rather suggests that there's some funny business going on in the Federal Bank of the Federal Bank of New York. So this just shows the problem when you have double ownership of gold. It's fine as long as nobody wants their gold back, or nobody wants to withdraw it. Now hold on a minute. Not so long ago, we had a problem with the Bank of England because they were queuing up to take gold out because the premiums on COMEX were so delicious that you needed to, go and lease gold and then flog it into COMEX, and you could strip out, I don't know, $50 an ounce or whatever the premium was. I mean, what's not to like? So COMEX actually, if you like, drained all liquidity out of other centres, particularly London and Switzerland. And I understand that even liquidity in Mumbai was taken out by this arbitrage. So now put yourself in the shoes of a central bank, let us say, which has gold stored in London. It's going to say, it's going to say quite reasonably, I don't want to lease gold anymore because I don't know what's happening. It's actually leaving the vault. Is it my gold that's leaving? I don't know. I mean, I think I'm going to stop this. I will probably want it repatriated. I will probably want some of it in London, but I don't want to lease it anymore. So the leasing game is stopping. That's the whole key. We've got no liquidity left in London or in Switzerland. New mine supply and scrap supply is spoken for big time by the Asians. I mean, they're just still hoovering the stuff up. Chinese insurance companies being the latest example. So we've got a liquidity crisis arising for the market because the supply, which the market might have expected from leasing, is drying up. So what does that do to things? Well, the lack of liquidity plus the lack of leased supply. And also bear in mind that the Bank of International Settlements very quickly closed down its position. Oh, like that. It saw this coming. So, yeah, I mean, I think we're in, as to the point about is this getting into a crisis, I think this is the beginning of a big squeeze on the Western derivative paper market, gold paper market system. And I mean, you could imagine that, if this does develop into a crisis, then it's the beginning of the unwinding of the entire derivative system. And we're talking here about trillions and trillions of dollars. I don't mean interest rate swaps because the principal is not involved in it, but things like foreign exchange positions and all the rest of it. I mean, you're talking about, several $100 trillion of liquidity, which is provided, systemic liquidity, which is provided by these paper forms of credit. And when that starts contracting, if that gets into difficulties, then it's goodbye our financial system. I mean, it's as simple as that. The only solution to this is to go back onto a gold standard. And the way to look at it is that, a mechanism has to be put in place whereby credit, the value of credit is securely tied to gold. And if it's not securely tied, then it's not good enough. It's desperately important that what we have today, which is failing, is replaced with something which is absolutely cast down. We know how to do it, or at least those of us who have studied the faults, if you like, of the Bank Charter Act in England of 1844. We know how to do it. It's actually not all that difficult. All this rubbish about there's not enough gold and all the rest of it, which the Keynesians talk about, basically means they don't understand credit. You've got to tie the value of credit. Now, the problem we have, I think, is that the people advising the system, if you like, don't understand economics. They think in terms of neo-Keynesian economics. They have to get off this ridiculous idea that gold is not money. Legally, it is money and has been since Roman times, since the 12 tables in Rome, 448 BC, declared the difference between money and credit. Tablet 7. It's all in there. You can Google it and have a look, and it's there. And it's been like that ever since. The Romans invented banking system, which we've refined, and we still have. So, in terms of resetting, as it were, there are so many hurdles to come over. And the other thing is, I think central banks are now very reluctant to let gold go. So the idea that a central bank will actually come up with a proper gold exchange for credit standard, is actually quite hard to envisage because of their attitude. They've got the gold reserves and they don't want to part with it. They would rather have some sort of, if you like, fancy idea about, giving people the confidence that we've got enough gold to back the currency without actually having to back it, sort of thing. So we could go down some false alleys, things like CBDCs. Again, it's just another form of credit. So, I mean, we had something similar at the time of the French Revolution, before the French Revolution, which actually ensured the French Revolution was going to happen. They issued something called the assignat. And the assignat, it all started off as these things always do. We will do this once. They did it once, and it was so successful. We want to do it again. So they did it again. So, you can see the exponential curve, if you like, of the assignat supply increasing. And at the same time, obviously, its purchasing power is going down exponentially. And this was, I think, a major factor behind the French Revolution. You can imagine what a collapsing currency does to ordinary people, if you like, the peasantry, the people at the bottom of the. I mean, they start burning things and killing people and all the rest of it. So you had the storming of the Bastille on July the 14th, whichever year it was, and then you had the revolutionary government, which continued with the assignats because they couldn't do anything else. But then someone had a bright idea, would come up with a new currency, and it's called the mandat territoriaux. Sorry about my French pronunciation. Everybody cheered. It was the end of the assignat. But how long did the mandat territoriaux last? It lasted 6 months, and that collapsed as well. And I think that's almost a lesson for what's going to happen when this fiat currency system collapses. They're already trying to explore alternatives with CBDCs and all the rest. They will probably come up with a new version of paper before we actually learn the lesson. And there's also the political aspect of this, which was, presciently covered really by Hayek in his The Road to Serfdom, which is written really about how Germany went, from a currency collapse into Nazism. But it's the same human psychology. When you get something as horrendous as an event as a currency collapse, the political system will collapse with it. And guess what? You will get an extremist elected because people, we want a strong man. We want a strong man in there to run things. What do you get? You get Hitler. We got a sort of mini version of that with Trump, who's screwing up everything. I mean, look, I don't criticize Trump for a lot of what he does. I mean, he's rescuing us from this woke rubbish. God bless him. But when it comes to economics, he is as ignorant, if you like, as his advisors. Let's put it that way. They just don't understand trade. They don't understand trade balances. And, they think it's the fault of the foreign that, US industry is on its uppers. I tell everybody, get the hell out of credit. It's a very difficult decision because, everybody's been conditioned to think I've got to diversify my portfolio sort of thing. So, getting out of credit will be 5% gold and the rest would be, say, transports and bonds and whatever. But all that's credit. I mean, all that's credit. ETFs are credit. The only way out of credit actually is to have physical metal, physical gold. And if you want to speculate a little bit silver, because with a gold-silver ratio currently running at about 95 or something incredible, I think that will probably come down as people begin to realize that it's the currencies going down, not gold going up. Because the same is true, though, as far as the central banks are concerned, they're not there buying silver. But it is also true of silver, which is an extremely useful metal. And I have no doubt that industrial demand makes this very cheap. I mean, the Silver Institute, for example, says that, the last 6 years we've been in supply deficit. But then when you put in monetary demand on top of that, as gold goes up, and silver becomes poor man's money, if you like, that really could motor. It could be a better way to protect yourself than gold. And of course, it's all very well saying get out of credit, but we need to have income to spend, and that comes from interest on bank balances, on dividends from companies, bond coupons, whatever it might be. Speculation, I think, is probably not a good idea. But basically, I think arrange your finances in such a way that you can weather the coming storm, however that storm evolves.